We have begun recording, and it's February 13 already, which means it's Valentine's Day tomorrow. Hope you guys have prepared. And uh, it's this is our, I think about this. We say demo. It's not really a demo. It's not a product demo. It's really a users group, right? We have a discussion here about how to use the platform, and we share what we know. Look, we've learned a lot too over the last number of years that we've made this available. This is the only market structure powered decision support platform, so far as we know, any place. So thank you for using it. And we're early on. So I think what I will do here is I will turn the floor over to Brian Wilson, who's got a number of things to cover, market strategist, and then I'll follow Brian. So Brian, over to you.
Perfect. Thank you. Thank you for joining, everyone. It's always a pleasure to see you all. As Tim mentioned, we welcome your questions. We welcome your interaction, whether that's here on the demo or just shoot us an email. Happy to unpack those questions as you have time to kind of think about them. Well, I've got 3 or 4 topics. I don't think I'll take too long today. I know Tim's got a lot of great topics to cover as well. I'll go ahead and share my screen, and we'll kind of begin by talking about actually the topic this morning. And I thought I had all my screens downloaded, and I didn't. It happens once in a while. So this morning, we were talking briefly about the mega cap portfolio. And I wanted to share something that you can do with any of the portfolios. And by the way, if you want to build something like the mega cap portfolio, I briefly mentioned it this morning. It's just create portfolio. You're going to select dynamic. And in this case, it's going to be market cap. And then it's going to be equals mega cap. And it's just that simple. And then you call it mega cap or call it whatever you want. But what I wanted to share with you was part of the reason that we watch the mega cap, part of the reason that we watch big tech. And what you can do with these portfolios is you can download the components of it. So this is my mega cap portfolio and actions, and you can export that to Excel. And then you'll get that there, and then you can do whatever you want, for that information. You can look at all the companies, you can look at demand, you can look at volatility, you can slice and dice it however you want to. What I did before the call is I took this portfolio, and I'm looking at a couple different ones. Let me show you what this is. So what we're going to look at first is my all equity portfolio, and it's just like it says. It's 2,985 companies. And then we're going to compare that to mega cap, and then going to compare that to our big tech. And there's a reason for my madness here. And let me show you what this looks like. So this is all portfolio. All portfolio. You can see the number of companies. That's about $72 trillion in terms of overall market cap. Take a look at mega cap. That's about 47 billion. Now look at that number. So we're talking about 120 companies. Previously I showed you that was almost 3,000 companies. So in other words, right now, 120 companies makes up about 65% of total market cap. That's why we pay attention to what's going on with mega cap. Take a look at big tech, about 20 trillion, making up about 28% of total market cap. So, the lesson is pretty straightforward. I think you understand the lesson. As those entities are moving in the market, they're going to dramatically impact what's happening in the market. And I tried to explain it this morning in terms of what I was seeing with mega cap. Well, let's start with the broad market look, and you can see why I think mega cap is starting to stabilize the broad market. Look at broad market sentiment. It's starting to form a bottom. You can always tell that it's bottoming when it really starts to slow down. We're going from 5.3 to 5.1 to 5 to 4.9. We probably bottom either today or tomorrow. So we're bottoming just slightly below neutral. Look at what's happening on the other side of things with mega cap. If we look at the mega cap portfolio, well, we actually bottomed a couple days ago. We got down to 5.7, which is well above neutral. And that is actually starting to trade sideways. That probably starts moving higher when we look at this data tomorrow. Look at what's happening from a short volume perspective. Shorts are getting covered. Do I think the market's going to rip higher from here? I don't know. But what I am seeing is some stabilization. And even with the whole market below neutral from a sentiment perspective, we were basically flat during the course of the last 5 days. I think a big reason why, because the mega caps are doing fine. They're not falling apart. And when they represent 65% of market cap, well, that's going to stabilize, what's going on in the whole market. So just wanted to share with you, a couple different things there. One, how you can download and export some of that information yourself. You can very easily create these portfolios. And just a reminder, 65% of market cap with mega cap. What was that, 28% with our big tech portfolio? That's why we watch those things. That's why you hear us talk about those sometimes ad nauseum. I'm sure you want us to shut up sometimes, but just wanted to walk through that with you. I did get a question from Barry this morning, and Barry, I hope it's okay to use this example, and Tim can actually tell me if I'm doing it wrong. Barry's question was, is there a way to look at something on when short volume is moving either up or down on a daily basis? And let me show you what I'm talking about here. I just created a test portfolio this morning, and what I was trying to do was quite simply to look at short volume moving lower on a given day. And I just created all kinds of variables here. Don't worry about all the variables. This is the important one right here, that short volume trend on a 1-day basis. So you can look at this for different elements, but short volume trend in general, that's looking at it from a 30-day perspective. You can look at it from a 5-day perspective, and then you can toss in a 1-day perspective. So what I did here, just for kicks, I had actually short volume trend moving higher over time, both on a 30-day basis and on a 5-day basis. And I just wanted to see if there were any companies where short volume actually started to move lower on a 1-day basis. And when I did that, there was only one company. Once again, I just set up a bunch of variables to limit the number of companies that I would see. But on that 1-day basis, there you go. Short volume is moving higher over time. Short volume now starting to move lower. And if you wanted to do that for any given company, you could obviously do that for short volume moving higher. I did it, of course, short volume moving lower. You would just change that, of course, to moving higher. So I just wanted to show you what that looked like. Barry, I hope that addressed your question, but different parameters that you can use here. You can look at sentiment days that are at 1, sentiment days that are at 10. As you're kind of looking at some of these things, and we haven't done this exercise for a while, if you have questions about setting up portfolios or how you can refine them, please reach out. We're happy to address those questions. I wanted to share with you one other aspect. I will turn it over to Tim, and then we'll kind of do the what's ahead together. I traded Tesla this morning, and I wanted to share, why I traded Tesla. So I will keep a watch list here. These are basically the top 15. Down below it is some of our clients from an IR perspective. But I'll glance at these once every 20 minutes, whatever. I don't glance at them all the time. But I noticed yesterday that Tesla was moving higher Most of the other big tech components really weren't. And then it was stronger first thing this morning as well. So it got me curious. And sometimes when I'm curious, I'll just go and look, especially when we're talking about top 15, right? So I noticed that Tesla was at a one, and short volume is moving lower. You've seen me do this exercise a couple of times here the last couple of weeks. This exercise is starting to help me out a little bit. What I'll do is I'll back it up for, in this case, I backed it up for a year. You really want to pay attention to the last 6 months or so. But what I was trying to decipher was, okay, what other times has Tesla been at a one, and what has it done afterwards? Well, if you look at this component here, Tesla was at a one from 731 to 812, 813. And then it, moved from like 200, 210, all the way up to, about 250. So certainly, very good appreciation for that particular run. This one was a little bit different, about the same in terms of the amount of time, moving from 1011 at a one up to about 1021, about 11 days. Of course, we had the election in here as well, but this was an incredible run, moving from 269 to 440. So I looked at Tesla right now. We got down to one about 2.4. We're 213 right now. It's been about 10 days, about a similar time frame. I'm like, why not? So sometimes I'll place some of these trades. They're not your typical, looking at the daily trading ideas. I'll do those as well. But sometimes just on my watch list, something will intrigue me, and I'll just go back and I'll look at the setup. What does it look like compared to the past? Do I expect this type of appreciation? No, I don't. Not at all. But at the same time, if we get a little bit of appreciation with a similar setup, I'm very happy with that. And for this particular time, when I'm doing this type of trading off of a one, I'm going to use lower dollar amounts. It's not going to be my normal position. I'm taking a chance on a trade. I don't have it vetted. It's just something that intrigues me, and and I give it a shot. Now, what happened today is I bought it this morning. It ran 2, 3, 4% from where I bought it, and I sold it. Why did I sell it when I like the name? Well, partially because I can go back into it again, but also look at what Tesla has from a volatility perspective. Its normal volatility is 5%. It ran over 5% on the day. Why should I continue to hold it? I took my profits. I'll go back into it maybe at the close today, maybe tomorrow. But I just wanted to share with you how you can trade just any given name really at any time. If you happen to be watching a name, go see how it normally trades over the last 6 months to a year. How does that compare right now? Obviously your best opportunities are going to be with your daily trading ideas. Those are fully vetted. That's looking at percentages over the last 90 days. What I did today is not vetted at all. And that's why I'm taking, smaller dollar amounts in those trades. But I'll do that once in a while, just because the data works. It works great. And you can look at what it's done from a historical perspective, and it gives you a really good idea of, what you can perhaps expect going forward. So with that, I will stop sharing my screen.
All right. Thank you, Brian.
Yep.
Let's see. I've got four things that I that I intend to cover, time permitting. I'm not brief. And I mentioned a couple of these in market desk notes. So these are going to be generally things that are, to me, important things to understand about how the market works. Add that criteria. I'll try to do that, Benham. I mean, what I want to do is take a look at it, run the correlations. I mean, what we did when we first put those criteria on, and one has to review them periodically, is we looked for statistical significance and changes relative to the trend. 1 day and 5 day really correlated to marked returns. One of the first things that we found was, we call it the Hicks rule because of Steve Hicks, who used it and found that it was very effective, is that when stocks with the correct liquidity characteristics get to 10 and the day over day short volume number declines, that was highly correlated to short-term returns, as was a 5 day decline. And I think it just goes back to the patterns. Something, Benham, that you've raised is that demand is far more stable a metric than supply. Supply is very erratic, and it gets to one of the things that I want to talk about today, which is why that's true. But we'll take a look at it. I mean, I had an engineering meeting at 6 a.m. this morning. I got an hour of skiing in, got a workout in with the trainer, bunch of meetings, got another IT meeting, and I got another one tomorrow morning. And part of that is looking at these criteria. So I am continually meeting with our engineers about the things that we can do. So we'll take a look at that. So here, where I want to start is the motivation of the market. It's one of the most important things that, to me, that investors and public companies should understand. I have this conversation all the time with public companies who spend all of this time and effort and money trying to attract investors. I mean, I've been part of my professional association in that profession, investor relations, serving public companies. I started a firm 20 years ago. That's the premier provider of quant data to public companies. And it is today. And, people are talking about European what we call NDRs, non-deal roadshows. We're going to go with some bank or some organization to try to meet with investors in Europe. Companies hold analyst days. They report earnings. And the audience that consumes that information is a net seller. I pull my hair out over this, that it's a failure to understand the addressable market. I think I shared this with you before. I shared it. I was on pre-market prep with Dennis Dick, Joel Elconin on Monday, and I noted this. I think I did share it, but if I'm repeating, apologies, but I think it's a really important point. This is data from S&P Global. We license GICS and other data from S&P Global, and they looked at the 12-month flows, December 31 to December 31, 23 to 24, and they clustered flows into 4 groups. Ironically, so do we, from a volume perspective. Actives. They say hedge funds, there's another way we would think of this, but just think of these as stock pickers, hedge funds who are long, short, retail, you and me, indexes and ETFs. And if you look at the lines, there's one net buyer, one, indexes and ETFs. What are the ramifications of that? Well, it's difficult to look at the market from an earnings multiple perspective. Is it overvalued by any number of metrics? Maybe it is, but this money doesn't buy multiples. It doesn't use research. It doesn't pay any attention to consensus. It doesn't pay any attention to, outcomes versus expectations, guidance. None of that stuff matters to money that uses a model that says you need to put 42% of your resources into equities. What's it going to go into? Well, stuff you can get in and out of, and that doesn't move more than 2%, as I've talked about over and over. Ergo, to Brian Wilson's point, the concentration in the market in large cap. I mean, it's really staggering how much of it is in a relatively small number of companies. S&P 500 is all the same as 90% of market cap. As I've mentioned before, the Russell 2000, people talk about, the Russell 2000 is underperforming large caps, so that's probably where the value opportunity is. That's not the right way to think about it. You have to think about What is it? Very much like Walmart. Walmart will measure the demographics of people coming into the store and consuming things. Who consumes the most and when and where, so that you have a supply chain. Well, this data will tell you stock pickers, all that time and effort that all these public companies spend trying to reach out to that audience. Why are they doing that? They lose $300 billion a year. I was reading something today about Fidelity, which has moved heavily away from actively managed accounts to stem outflows. Capital Group did that. Why do I go on and on about this? Because you are an investor and a trader. And to have the market do what you expect, you have to understand what the money is doing. And this is what the money is doing. It's going into models. And then number two in the market is machines that set all the price. Today, why would the market be down on a whiff of possible tariffs, and then we announce sweeping reciprocal tariffs today, and the market's up? Well, this gets to the importance of understanding market structure. The mechanics and behaviors and regulations of the stock market plays a very big role. Well, if you look across these portfolios, look at this behavior. It's a demographic. It's a demographic that's responsible for nearly all the prices. It's dominating the market right now. And 50% of the volume. Could be a lot more in small caps. But that fast trading, fast trading, fast trading, fast trading, fast trading, fast trading, passive in big tech, because they have to, right? Fast trading in communications, consumer discretionary, fast trading, fast trading, fast trading, fast trading. Everywhere you look, it is not flows. It's machines with an investment horizon of a day or less. Now, it could change. And what often comes when there is an investment horizon of a day or less that is determining the direction of the market is you get a sudden shock. I've been, talking about this, and we've gotten them repeatedly. We haven't had the big one, capital letters. I was going to show you some data, and I didn't pull it up in time, about the cycles of the market that are very evident in volatility. Ben, I'm back to your and my discussion. What are the three things that determine outcomes in the equity market? Demand, supply, and volatility, period. That's what does it. For passive money, volatility is very important. If you have, I see it all the time. I had a big meeting with my, advisors who manage a bunch of accounts for us, manage our 401k plan, and for our businesses. And we talk about how people come with products all the time. They're seeing people all the time who are selling products. Like, put your money in this thing, which is why I always look carefully at the things they suggest, right? But they're selling products. Those are wholesalers who sell products. Well, if you've got volatility in your product, they're not going to sell your product. So it's very important for the purveyors of index funds and ETFs that those things do what they're purported to do. And the thing that wrecks it is volatility. What determines the general direction of the market is demand and supply. That's why we track these things. If you look at consumer discretionary, flat demand, rising supply. Consumer staples, flat demand, rising supply. The central tendency. The Dow Jones Industrials, flat demand, rising supply. You could go all across your market. Even the big tech, generally, you say they're kind of paralleling each other. Demand and supply gently rising. Those are the trend lines. Mega cap. Again, what would you say is the trend line? Slightly up, but certainly the supply side is up. There are short-term fluctuations, so that's what we're using. We use short-term disparities in those measures to produce short-term trading returns. That's what we're doing. Then longer term, you have to be aware of how those things are changing. But it really gets to the importance of understanding there are behaviors, there's a cadence and calendar, there are trends that are observable, and you need to be aware of them. And Brian and I are going to talk about what's next. And he and I might have I continue to believe we are in the very beginnings of a big cycle change. I don't know if that'll be affected, but I can see it in the volatility. Volatility pre-pandemic had very short cycles, but much higher standard deviation. So you would go, Like high volatility, rugged market, volatility would decline, market rises, and then it begins to tick up, and the market gets rocky again. And it repeats and it repeats and it repeats. With the pandemic, that cycle has been stretched out by a factor of 4. We went through one from March of 2020 to 2022. Now we're going through another one. I would hazard that we're at the end of that cycle because volatility is rising. Now, again, I don't know what's going to happen. You don't know. But those patterns are very apparent, and they're a product of recognizing that the market is not qualitative, it is quantitative. Prices are set by machines. Most of the money follows a model. Those are very important things to think about as you go into the market. Next thing, very quickly here, because I said I would touch on it, is for some of you, this will be redundant. I have talked about the market making exemption to short locate rules. So for those of you, if you're like, oh, Quast, I remember this stuff. If it's new to you, let me just briefly explain it, because it's very important if you're going to go long and short, and I do, and we do. Barry Norton, you're good at this, is to recognize that the supply side is very elastic. It's much more elastic than the demand side because the SEC exempts market makers who are engaged in what's called bona fide market making. So there's Reg SHO Rule 201. That governs how stocks may be shorted. And then there are multiple additional rules. Rule 203 governs what broker-dealers have to do if they're lending securities. And there's a rule called Rule 203b2 that says you have to do A, B, C, and D, unless you're a market maker like Citadel. These fluctuations, these big bumps that you see on the supply side here, all of a sudden there are gyrations. Let's look at Celestica. Presuming it read that. What happened here? Well, here's a big covering. Here's a bunch of, this is orders getting filled. There isn't enough supply in the market for the demand in Celestica that needs to be filled. So Citadel simply creates stock. They are exempt from having to locate shares to short when engaged in a continuous auction. That's what's happening. Bids and offers, all automated, and all of a sudden a bunch of orders come in that are marketable between the bid and the offer. Well, Citadel can't say, sorry, there was no stock available. The SEC would rather that Citadel create stock and fill those trades, I'm picking on Citadel, than that Citadel would not fill a trade. So this causes fluctuations in the supply side, but they have to be rectified. So you get a short-term period of 1, 2, 3, 4, 5, 6 days, maybe. That's why we do that, 1 to 5 days, right? Where you might have an opportunity, but that's going to have a consequence. And son of a gun, it did. And here Citadel covered its position. It restores the order. That's happening all the time. And it becomes an end to itself, which is why, Pam, to technical analysis, I have a hard time depending on it. I find that you can get caught out. And I talk to a lot of people, and I still say, how many rich technical traders do you know? I said this to the global head of products at Interactive Brokers. I said, how many rich technical traders do you know? He said, 2. No, wait, 3. That's the joke, right? It's a joke. But I know that machines are continuously doing this, and they're a massive part of the market, so you can't depend on it. You can only depend on the broader measure of demand and then short-term asymmetries in demand and supply. To me, central tendencies, I'm speaking in central tendencies. There are always exceptions, and you might get successful, but I don't like to get caught out. So I'm very careful about those things. I know that a lot of the prices are set by participants that have a horizon of a day or less, and they are really prevalent in the market right now. At this moment, investment behaviors are down and machines are setting all the prices. Now, maybe that works out fine, but it makes me a little uncertain. Third, and then we'll wrap up with number 4 will be the look ahead. There was something I put in there, Brian. Maybe you can remind me. Something about a look ahead in concert with the look ahead. But my third thing is when tech. Oh, I remember. We have a little tease. So what happens when tech stops leading? It's really because the market depends on it and how long has it been true. Do I have this up? I think I do. Um, well, we could do it this way, right? So you could look at XLK over whatever period of time. Um, I'm going to do 1 year if it'll give it to me. Let's see. This was inefficient, and apologies for that. It's loading. Maybe I'm faster this way. Let's just do this. Um, it's a way to just think about what's occurred. When did tech stop leading? Well, you could say maybe back here, in July, we saw that. Remember that? I don't know if remember, we warned people that everybody was short tech at July options expirations, and the market tipped over. Now, that same problem doesn't exist now, but tech is the momentum part of the market. We're heavily dependent in our momentum queries on tech. It's not the only thing, but it is the core part of the market that has a propensity to have higher volatility. And it has not led the market. Now, you can say, well, is it about to change? I don't know. But I look at the supply and demand balance in tech, and it's not good. If we run model portfolios, low volatility has pounded momentum for returns over this period of time. I just find that interesting. So, am I all excited about this? No, I'm suspicious of it because of what you can see generally in these broad trends. And so, I haven't yet figured this out, but we're getting close. Been doing a lot of study. What I have tasked the engineering team with doing is providing some model portfolios. I mean, we don't give advice, we don't manage money, we provide information for decision support. That's what we do. But we could run models that'll tell you, here's what you should, if you're running a model portfolio, here are the things to buy, here are the things to sell, here's the performance data over various periods of time, and here's when you should be in momentum, here's when you should be in low volatility, and make that part of the, the things that you can do, longer term versus daily trading ideas, shorter term returns. And if you can do both, man, you can really stack your returns. And, our aim is to outperform the market. It's very, very difficult to do. But as I pointed out in the market desk note, low volatility has doubled the performance of the S&P 500 as a model portfolio year to date in 2025. So we're going to do that. All right, Brian, let's you and I in quick fashion see if we can paint a short-term picture of what's ahead.
Sure, I can start off if you want, Tim. My look is more short term. I totally agree with Tim on that longer term perspective in terms of the potential for volatility. So what I'm about to say is more of a short term look, and I'll share my screen again just so you can see this. I've talked about part of it already. We look from a short term perspective at the fact that broad market sentiment is, probably going to start bouncing today, I would imagine. We had talked about this last week during the demo, and I had mentioned at that time that I expected shorts to start to get covered. Why did we say that? Well, look at what's happened over the last year. We were at 50.7 last Friday. Look at how many times we've been at 50.7, during the last year. I think it's been twice. And both times shorts started to get covered from that point going forward. Could we have gone higher than 51? Of course. These are speaking in central tendencies. But we started to get some short covering. I expect that will probably continue here in the short term. We're probably going to start bouncing from a sentiment perspective. We're getting a little bit of stability once again with the mega caps, which are well north of neutral. And big tech, although it's not as good as mega caps, it's not bad. It's roughly right around neutral right now. It has stopped moving lower. Short volume moving just a little bit below trend. I add those things up. I think we have some upside here, on a short-term basis. There are a couple of things to watch out for. We do have a holiday on Monday, and then we move into options expirations next Wednesday through Friday. And really, at that point, all bets are off. So what I'm talking about right now, it is very much short term in nature, but I do see some stability in the short term once again from the mega caps, from big tech, and then from broad market sentiment and short volumes as well.
Uh, Joe, just to put a capstone on Brian's answer, T plus 35. Technically, T plus 35 is what the regulations say for market makers to have rectified the imbalance. They don't even specify that you have to have it covered. You have to have your value at risk squared. So theoretically, a market maker like Citadel could say, well, wherever I have an imbalance, I know that they all run books and they know exactly what their long short positions are and where there are edge cases. They could say, well, we're still short this thing, but we have now covered that. So we've met our regulatory requirement to have value at risk squared. Now, over time, those things will have to get sorted out. It has caused problems. There have been proxy battles where proxy solicitors have misinterpreted the amount of supply in the market because of these market making exemptions. You end up thinking that you've won the proxy battle, but you didn't have it right because you didn't have a correct count. I mean, it's crazy to me how this works, but somehow it generally does. As to the look ahead, generally I concur. I'm cautionary because there are things happening that concern me about where we are with broad sentiment. For instance, this was a top, right? This was a top, and it was correct. I mean, in the sense that the market dropped sharply, but then it took off.
Tim, can you share your screen again, Tim?
Oh, thank you. Yeah, stopped sharing, didn't I? I'll do this. I'll try to be very. It's 109, so I'm aware. 109 Mountain Time. So here's what I was pointing to. This is a steep bottom. This is a very weak top. And it was in the sense that, this is SPY. SPY did indeed drop, but then it sharply recovered right into options expirations, key thing. And then it took off so that we didn't have what you would anticipate, which is a weak top, and then it declines again. So here we've had a strong top right into options expirations, and a decline. It's at 4.9. It is technically negative. So even though that is could it be a bottom? Daily read, is around 4.8 and staying right there. It really depends on what happens in the next few days. But could this continue down? Well, I don't know yet, right? You could say, well, it's bottoming and supply has peaked, as Brian pointed out. It took a very long time. It's basically doing what it did here. Now, I don't know what's going to happen next. This is the problem. This is a change in the demand supply balance. To me, this is a weak supply and a weak demand condition. And these things, as Brian said, they tend not to produce the kind of relentless pelting gain that you would find, I'm going to back this up, under conditions that are much more pronounced. When you have this kind of very strong demand and a decline in supply, you can count on producing long returns. This stuff does not look good to me. I've said this several times. I don't look at this and say a mild pullback gives me a strong signal. I still think we could step in a black hole here. So I would caution you to be wary. That's all. It's just not the kind of market where you could go, oh, it definitely bottomed and supply's plunging, and this is a great opportunity to buy stuff long. We had this when you have awesome conditions, it's pretty apparent in the data where you have very sustained demand, spend a lot of time above 5. I've said that this deteriorate, it started here. This is the first big hit we've had since 2022. It's part of why I think I'm careful here. I'm certainly not pushing all my chips in long. So I just want to caution you. That's all. I don't want you to go deploy a bunch of money and then the market tips over because I think that that's a risk. Fast trading is leading. Demand at 4.9 probably bottoms. That's not an entry point. We always say, great entry points are below 4, but then great entry points that have weakening demand trends also can precipitate a bear market. So we are rolling on the log right now. We are straddling the fence of those two things. And I can't tell you which one it is yet. No. All right. Now you may think me overly cautious. Yes, Benham, please.
Yeah, I got a question. Excellent topics on broader market, but on a given trade, what I find myself is that my exits are not my problems. I take my stops. I take 1%, 2%. I get out. I don't carry overnight. That is not the bulk of my problems are my entries.
Okay.
Let's say I avoid the option expiration, all of that, and we've chosen XYZ to enter, and it's early in the morning. What would you do? Do you ignore the first hour of trading as we normally do? Or as it is within the range, you just jump in, or you give it some. And I've heard you saying, don't wait for confirmation, which is a hard thing to do. So please, maybe this is a good topic for next week if we don't have much time. But entries are my problem. And I don't have a good time. And if I analyze my failures, perhaps 90% of my failures, losses, are my entry problems. So help me.
In some ways, I would say I really understand that exits are easy. You always can take your gains, right?
Yeah.
It's hanging on, like you enter something in the entry range, and then all of a sudden it's down all of the volatility. Those things can happen. And what conditions create that? Well, if you could analyze yourself right into paralysis, couldn't you? That's what happens. You're like, well, I'm going to avoid options expirations, and I'm going to avoid the month-end options expirations. And now demand is peaked and falling. And the Fed is, Jay Powell's talking. Pretty soon you got 1 day left a month to trade, right? That's not going to work, is it? So all I can tell you is that when demand is rising strongly in the broad market and supply is below trend and falling, I'm very comfortable taking the entry range and not worrying about the volatility that may develop in the first hour. And sometimes, in those conditions, in momentum markets, man, I've had so many great times where literally in 4 minutes I make my money and I'm gone. Right? I buy it, particularly if I buy it the day before. Buy it the day before, wham, I make my money. That is my favorite. My favorite is buying the last 10 minutes when all the reference prices are already being set. Last 10 minutes of the market, and I'm right out at the next day. And if I'm not in the range, then I'm content. I know I've got 4 more days for chances, because that's what the trend and the pattern is. It is definitely harder on me to buy first thing in the morning. I agree with that. And particularly under these conditions, I mean, I could say Celestica did well. Oklo actually did well with all of that volatility. You could have made money on all those things. I looked at the momentum stocks. Man, you could have made money on all of them. But it would have been stomach churning, because those things really moved down on you for a period. They moved down, and then you catch the run a day or two later. So again, I come back to the volatility, the volatility that you have to stomach, and it's rising. So right now the volatility in the S&P 500 is 2.5%, Brian, thereabouts. In the average component. I mean, that's your minimal risk tolerance right now to me. And it's really hard to take a 3% risk, but that's where I arrive. And I'll finish by saying it's challenging right now. Low volatility is working better. It's not nearly as interesting, but it's working better.
Yeah, but my question is more of a mechanics.
I get you.
Let's say everything equal. How do you jump into the market? You just, when it is in the range, no matter what time of the day, you just go in, or you even set your trades before the market opens. Or, what is, I'm sure there are also, I don't mind the volatility because I factored that into my stops.
Okay.
So that's not the issue. The issue is my entry.
Yep.
And
so, again, my preference, I'll give you 2 pillar answers to that. If if the broad market, so if I, if I click ASTS here, I'm just going to pick this. What I will do is always look at the broad market and say, what is it doing? Well, I don't love that. It's just, even you can say, well, it's bottoming. Well, I don't know if it is. I could, this was a top, but it wasn't. So it's just in this period where the broad signals are giving us exactly what the market is doing. You don't know from one day to the next what it's going to do, how it's going to respond, and that is exactly what the data indicate. Ergo, I'm less likely to risk it all day. I'd be much more likely to go back here to the momentum portfolio and say, I'll buy this in the wherever it is in the entry range, last 10 minutes of the day, with my aim to get out the next day. I feel really comfortable if that's pillar number one. Pillar number two is if, and I mean, that's good, right? That's good. You look at that and say, the chance of making money on that is really high. But the other pillar is, if broad sentiment is rising, I'm much less concerned. If we're in a period where that, and this is mechanics to me, it's exactly how I do it. I will look at the broad sentiment and say, I mean, if it's screaming up and supplies come, you realize there's 4 or 5 days in here. If I'm under those conditions, I don't really care. I just take the entry range right off of the day and maybe multiple things, and I don't care because I know that data is almost certain to give me a return. So I only become more cautious when those broad signals become really muddled, as they are now. They're very muddled, and that's the risk. That increases the risk for us. That's what it is.
Okay.
Yep. Okay, we went long, but that was really important, and we can, we can pick that up again. And John, I have not forgotten about you. You are on my list. I'll tell you, I've been buried. We had an engineering change, and I had to scramble and make sure that all the hands-offs have occurred, and I've just had my plate full. I'll come around to you. Okay, good to see everybody. Thank you very much. Enjoy the weekend, long weekend. Markets are closed Monday. Man, that's risky too. Close Monday, Tuesday, Wednesday, Thursday, Friday are options expiration dates. I mean, I think, again, maybe nothing happens, but it's like you're just waiting for something to go bad with when you have machines that are dominating the price setting. They don't like to hold stuff like that. And if they're the ones setting all the prices, just makes me so Candace, this is one of those situations where you don't want to hold a position for Saturday, Sunday, Monday, Tuesday, right before options expirations. Just, be careful. Yeah. All right, you guys. See you next time. Thank you very much.